Hello, Garudarians. Casting off log, wow, what a roller coaster of a day in the global markets. We saw a huge international event just send shockwaves everywhere, from oil fields all the way to stock exchanges. So let's break down what on earth happened and why.
Boom. This was the number that really set the tone for the entire day. The Dow Jones Industrial Average dropping almost 400 points. I mean, that had traders on edge right from the opening bell. So what could possibly trigger such a steep sell-off?
Well, this wasn't about a weak earnings report or some bad economic data. Nope, this anxiety was purely geopolitical. Tensions were just flaring up in the Middle East, and that created immediate uncertainty. And in the financial world, uncertainty almost always leads to a flight from risk.
So, let's really dig into this idea of a geopolitical shockwave. When a conflict breaks out, especially in a region as critical to the world as the Middle East, investors, well, they have to recalculate risk, and they have to do it fast. That sudden reassessment is exactly what we're seeing in these sharp, crazy market movements.
And you don't have to take my word for it. Experts like Savita Subramanian from Bank of America are calling it exactly what it is, a geopolitical shock. Now that term she uses, risk premium, that's the key. It's basically the extra bit of cash investors demand to hold on to something risky, like a stock, when the world suddenly feels a lot more dangerous. And when tensions rise, you better believe that premium goes way up.
And here we go, the most immediate consequence. West Texas Intermediate, which is the benchmark for U.S. oil, jumped 4%. This is a direct gut reaction to fears that the oil supply could get disrupted, since this is all happening in a region that's just vital for the world's energy.
And this wasn't just a U.S. story, not at all. Brent crude, that's the big international oil benchmark, it shot up too, rising over 3%. It's just a powerful reminder of how connected everything is, right? A regional conflict can directly spike your gas prices thousands of miles away.
Okay, so now let's pivot to the stock markets, because this is where the reaction was, well, surprisingly complicated. While the first instinct was definitely fear, the story wasn't the same everywhere you looked. In fact, we saw this really stark difference between how Asia and Europe reacted as the day went on.
I mean, this is where the story gets absolutely fascinating. On one hand, you have Asian markets just staging this massive rebound. South Korea's Kospi had its best day in years. But on the other hand, European markets were just a sea of red. So why the split? It just goes to show you that different parts of the world can interpret the exact same global event in totally different ways.
So what's a long-term investor supposed to do with this kind of panic? Well, some analysts, like Dirk Willer over at Citi, argue for taking a step back. He's suggesting that, historically, these geopolitical shocks are often short-lived and might even be buying opportunities. His whole analysis points to this pattern. The day oil prices hit their peak is often the same day the market hits its bottom. Interesting, right?
But hey, the geopolitical news wasn't the only thing driving the market today. Not by a long shot. To really get the full picture, you gotta look under the hood at company-specific news and the underlying health of the economy. So let's zoom in on those key signals.
This slide just illustrates that point perfectly. While the whole market was down, we saw these huge individual moves. The trade desk skyrocketed over 20% on some good news. At the same time, BJ's wholesale fell because of weak guidance. It just proves that even on a day totally dominated by global fears, a company's own story can still matter the most.
And, beyond individual stocks, traders were also busy trying to make sense of fresh data on the U.S. economy. These fundamental numbers, they provide the backdrop for all the market drama, and they're busy telling their own story about economic strength. First up, some pretty good news, actually. Fourth quarter productivity grew by 2.8%, a full percentage point higher than anyone expected. Now, this is a great sign. It means the economy is producing more with less, which is really a key ingredient for sustainable growth.
However, and there's always a however, isn't there? The data also presented a challenge. Unit labor costs also rose by 2.8%, which was also higher than expected. This is kind of a potential warning sign for inflation, because it suggests wage pressures could be building up in the economy.
And the final piece of this economic puzzle for the day came from the labor market. Weekly jobless claims held steady at 213,000, which was just a little below what people were predicting. This points to a job market that's still stable, still resilient, adding yet another complex layer to the day's whole narrative.
So to recap all of this, what we saw was a classic market tug-of-war. On one side, you have this massive external shock from a geopolitical conflict just driving fear and volatility. And on the other, you have the fundamentals, company performance, economic data, telling a more nuanced, more resilient story.
Understanding both sides is the key to making sense of days like this. Hey, if you found this breakdown helpful, be sure to hit that subscribe button for more explainers just like it.
And all of this leaves us with a really critical question. With geopolitical risk on the rise and a really mixed bag of economic signals, are these sharp, volatile swings something that we as investors just have to accept as the new normal? It's a question that will probably define the markets for the foreseeable future. Thanks so much for joining us. Dharmo Rakshati Rakshita.